Okay, so usually when we see a token rip, 75% in a single day, we ignore it.
Right.
We assume it's a meme coin, a pump and dump, or, I don't know, maybe Elon Musk tweeted a picture of a dog again.
Yeah, you just assume it's noise. But what happened 2 days ago on February 12th? That was not noise.
No.
It was a signal. A very loud one.
We are talking about Berachain ticker BER.
Yeah.
And after what I think we can charitably call a grueling 2025, the chain has suddenly woken up and just chosen violence against the rest of the market.
It really has.
It's February 14th, 2026, so if you're holding BR, this is a pretty nice Valentine's Day gift.
It is. It's vindication for the people who stuck around during those 90% drawdowns last year. But you're right, this isn't just number go up.
Not at all.
There are two massive fundamental shifts colliding here.
Exactly. We aren't here to just talk about the price action, we're here to talk about why it's happening. Because when I went through the research you sent over, I realized this isn't just a market cycle thing, it's structural.
It's a convergence. On one side, you have this strategic pivot they're calling Bera Builds Businesses,
right,
which is a total reimagining of what a layer one blockchain is supposed to do. And on the other, you have the removal of this massive financial sort of Damocles that's been hanging over the project's head since launch.
That's the refund story. We'll absolutely get to that because that is some high-stakes corporate drama. But I want to start with the identity crisis because, well, Berachain is baffling, right?
It's the strangest trajectory in crypto history.
It's this serious institutional infrastructure project that is currently beating Ethereum to its own technical upgrades. But it started as a collection of, and I'm quoting here, bong-smoking bear NFTs.
Bong bears.
Yeah. You
really can't understand the 75% rally today unless you understand the bong bears of 2021.
Okay, so take us back. How do we get from stoner JPEGs to a multi-billion-dollar financial layer?
So rewind to August 2021. NFT summer is in full swing. Everything is selling out. And out comes this collection. Bong bears. It's exactly what it sounds like. 100 hand-drawn bears. All cannabis themed.
And the founders are anonymous.
Totally. They go by names like Smokey the Bera, Papa Bear, Dev Bear.
Which, let's be honest, usually screams rug pull.
If I see a founder named Smokey the Bera, I'm keeping my wallet very closed.
On the surface, absolutely. But beneath the memes, these guys were actually deep DeFi natives. They were heavily involved in Olympus DAO, remember OHM, and the whole 3-3 era.
That was the game theory protocol, right? Where if everyone held, everyone won.
That's the one. And they applied that game theory to the NFTs. They created a rebase mechanism. If you held a bong bear, you could create new generations. Bond bears, boo bears, baby bears.
So it wasn't just art.
It was a mechanism to lock people in. It created a sticky, culturally cohesive community. They built a cult before they wrote a single line of blockchain code.
And that's the key, isn't it? In crypto, liquidity is usually mercenary. It goes where the yield is. But a cult stays through the winter. Precisely. And that cult capital allowed them to identify a massive flaw in the wider market. They looked at Ethereum, at Solana, and they saw a fundamental problem with proof-of-stake.
Okay, break that down for us. What was the flaw?
Well, think about traditional proof-of-stake. To secure the network, you have to stake your tokens, right? You lock them in a validator.
Sure, skin in the game.
Right, it makes the network safe. But it makes that capital totally useless. It's idle. It's just sitting in a digital vault doing nothing.
So security comes at the expense of liquidity. If I want the chain to be safe, I can't use my money for, trading or DeFi.
Exactly. If everyone stakes, there's no money left to trade or lend. So the Berachain founders asked a really simple but radical question. What if security was liquidity?
What if they were the same thing?
What if, instead of locking tokens in a vault, you secure the network by putting tokens to work in the liquidity pools that power everything?
And that is the birth of Proof-of-Liquidity.
And that's the engine. Paul.
Okay, I want to double click on this engine because the documentation mentions a tri-token model. And I think this is where people's eyes glaze over.
It is, yeah.
You've got Bera, BGT, and Honey. Why 3 tokens? Is this just complexity for its own sake?
It seems complex, but it's actually designed to separate incentives so they don't cannibalize each other. It's pretty elegant.
Okay, walk us through it.
Let's strip it down. First, you have Bera. Historically, this is just the gas token. You use it to pay for transactions, just like ETH on Ethereum.
Easy enough.
Then you have Honey. This is their native stablecoin pegged to the US dollar. This is the oil of the system. If you want to trade or lend, you need a stable unit of account.
Right. You don't want to be pricing loans in a volatile bear token. Gas and stablecoin. Standard so far.
But here is the magic variable. BGT. the Bera governance token. This is the special sauce.
Okay.
You cannot buy BGT. You can't go on an exchange and pick it up. It is non-transferable. It's soul-bound to your wallet.
Wait. So if I have $1 million, I can't just go buy a bunch of BGT and take over the governance of the network.
Nope. You have to earn it. And the only way to earn it is by performing work for the network, specifically by providing liquidity.
So I have to put my assets into the Berachain exchange, the BEX, or other apps to get it.
Exactly.
So why do I want BGT? What's the payoff for doing that work?
Two things: power and bribes.
You can't just say bribes like it's a normal thing.
I mean, in DeFi economics, it is. Look, holding BGT lets you vote on which liquidity pools get future rewards. Validators want that power. Protocols want that power.
Because they want liquidity for their own tokens.
Right. So they bribe BGT holders. They say, hey, delegate your BGT to our validator, and we'll pay you X amount in tokens.
So it creates a flywheel. I provide liquidity to earn a BGT. I use the BGT to get bribes from validators, and those bribes incentivize me to provide even more liquidity.
Exactly. It forces capital to be active. Unlike Ethereum, where you can park your money and go to sleep, on Berachain, your money has to be working to maintain your governance share.
Okay, so that's the theory. It sounds great on paper, but we established at the top that 2025 was grueling, the price tanked, the flywheel didn't spin. What went wrong?
The flywheel had a leak, a big one. The liquidity was all mercenary. People were just farming the BGT, dumping the rewards immediately for cash, and taking that money off chain. There was no sticky value.
They were printing money to rent loyalty, but the loyalty expired as soon as the check cleared.
Perfectly put. It was inflation without retention. Which brings us to this week, February 2026, the pivot.
Bera Builds Businesses.
Right. The foundation realized they couldn't just rely on DGen's farming yield. They needed real cash flow. So they stopped acting like a meme chain and started acting like a chain-level Y Combinator.
That's a bold comparison. Y Combinator built Airbnb and Stripe. What is Berachain building?
They are incubating, acquiring, and partnering with businesses that generate external revenue. They call the goal emission neutrality.
Meaning the apps on the chain should make enough money to offset the inflation of the BGT rewards.
Exactly.
To give us some concrete examples, real revenue is a buzzword every crypto project uses.
True. But they have a few S-tier projects that are fascinating. The first one is called Liquid Royalty. They're tokenizing e-commerce royalties.
E-commerce, like financing for Amazon sellers, that kind of thing.
Exactly that. Financing for brands. They're bringing a pipeline of potentially $1 billion in income streams on-chain.
Yeah.
That's not crypto money. That is real-world consumer spending.
Okay, that's significant. That's actual economic activity being routed through their ecosystem.
And then there's Sukukvi. This is one of my favorites, just for the sheer juxtaposition. It's Sharia-compliant tokenized telecom bonds.
Wait, hold on. Sharia-compliant telecom bonds on the Bear chain.
The irony is incredible, isn't it? But yes, these are institutional-grade fixed-income products. This isn't gambling on dog coins. It's boring, reliable telecom debt revenue.
So the thesis is, bring these boring, high-value revenue streams on-chain, and the network fees and usage will generate actual value that supports the token price.
Yes, and there was a technical upgrade in Pol version 2 that ties this directly to your wallet. It's what they call real yield.
How does that work? Why do I, as a Bera token holder, care if some telecom bond sells?
Because before, Bera was just for gas. Now, 33% of all protocol bribes, those incentives we talked about, are automatically converted into wrapped Bera and distributed to people staking Bera.
Whoa, so just by holding and staking the main gas token, I'm capturing a third of the economic activity of the entire ecosystem.
Correct. It turns Bera from a simple utility token into a productive, yield-bearing asset. If Sukukvi and Liquid Royalty are generating millions in fees and bribes, Bera stakers get a cut.
That explains the institutional interest. I saw a headline in the notes about a NASDAQ-listed company, Greenlane Holdings.
Yes, GNLN. They're a public company, and they just pulled a MicroStrategy.
Meaning they put Bera on their balance sheet.
They announced they were buying $8 million worth of Bera for their corporate treasury. But, and this is the key difference, MicroStrategy just buys Bitcoin to sit on it. Greenlane bought Bera to plug it directly into the validator network.
To get that 33% yield.
Exactly. It's a cash flow play for them. It validates the whole Bera Builds Businesses model in a way that retail speculation just never could.
Okay, so we have the pivot to business, we have the new yield mechanics, and we have public companies buying in. But you mentioned a sword of Damocles. What was haunting them?
This is the part that kept sophisticated investors on the sidelines all through 2025. It involves Brevin Howard, one of the biggest hedge funds in the world.
They were early investors, right?
Series B. They put in $25 million through their Nova Digital Fund. But there was this really weird clause in the contract. A refund right.
A refund right, like returning a shirt at Target.
Basically. Nova had the right to ask for their entire $25 million back in cash for up to 1 year after the token generation event.
And the token generation event was February 2025.
Right. So for the last 12 months, the market has been terrified. Everyone knew that a massive whale might just pull $25 million of liquidity out of the system. It suppressed the price.
It's like trying to buy a house, but knowing the foundation might get ripped out from under it in 6 months.
Perfect analogy. But the deadline was this week, early February 2026. The window closed.
Yeah.
Brevin Howard did not take the refund.
Wow. That is a massive signal.
It's the ultimate vote of confidence. They look at their BR stack, they looked at the $25 million in cash, and they decided the BR is worth more.
So the sell pressure that everyone was dreading just evaporated.
It vanished.
Yeah.
And that helps explain the 75% rally. You combine the removal of that fear with the new yield mechanics, and the market just reprices the asset instantly.
It makes perfect sense. The suppression is gone, and the incentives are higher than ever.
It's the perfect storm. And it clears the runway for them to actually focus on the technology, which we haven't even really touched on.
Right, let's talk tech. Because usually when we talk about these business development chains, the tech is kind of boring, but the notes say Berachain is beating Ethereum to the punch.
It's surprising, isn't it? Berachain is EVM identical. Now, a lot of chains claim to be EVM compatible, meaning they sort of mimic Ethereum.
Right.
Berachain runs the exact same execution clients as Ethereum, just on a different consensus engine called Comet BFT.
Okay, translate that. What's the user benefit?
Speed and finality.
Yeah.
Your transaction is done and irreversible in about 2 seconds. But more importantly, they're acting as a live test net for Ethereum's future. In Q1 2026, so right now, they implemented the Bectra hard fork.
Bectra.
It's their version of Ethereum's upcoming Pectra upgrade, but Berachain shipped it first.
And what does Bectra actually do for me, the user?
Universal smart accounts. Imagine this. You want to buy some of those telecom bonds. On current Ethereum, you'd need ETH for gas, you'd need to approve the token, then swap, then sign.
It's a nightmare.
Right. With universal smart accounts, you can batch all that into one single click. And this is crucial. You can pay for gas in honey.
Hold on. So I don't even need to hold the volatile BERA token to use the network. I can just use the stablecoin.
Exactly. That removes the single biggest friction point for onboarding normies. If you're a corporate treasurer buying bonds, you don't want to manage gas exposure to a volatile asset. You just want to spend dollars. Berachain makes that possible today.
That is a huge competitive advantage for onboarding those real-world businesses they're targeting.
It is. It really challenges the entire industry standard. For a long time, the crypto model was build the blockchain and the apps will come.
Build it and they will come.
Berachain tried that in 2025, and it was mediocre. The new model is we will build the businesses for you.
It's an economically closed loop. The businesses on the chain pay for the chain's security.
And the security provides the liquidity for the businesses. It's a symbiotic relationship we haven't really seen executed at this scale.
So let's wrap this up with the big picture. We've seen this massive rally. The hype is back. Is this just another crypto cycle, or is this something more, a new standard?
Well, we never give financial advice on this show. But if you look at the fundamentals, the structure of the chain has changed this week. Period. The mercenary phase is over. The institutional phase has begun.
The narrative has shifted from farming rewards to earning real yield from real businesses.
Precisely. But the burden of proof is still on them.
How so?
We need to see the Q2 reports. We've heard the pitch, liquid royalties, Sukut fine. Now we need to see the volume. Does that revenue actually materialize? Because if they can prove that a blockchain can run on external revenue instead of just token inflation,
it changes the game.
It changes the game for every layer one out there. Solana, Avalanche, Monad, they will all have to answer to the Berachain model.
That's the takeaway. Don't just watch the green candles on the chart. Watch the revenue of the apps being built on top of it.
Exactly. That's where the truth is.
From bong bears to bonds. Only in crypto.
Only in crypto.
Thanks for diving in with us. There's a lot to digest here, but it seems like the bears might have started as a joke, but they are building something very, very serious. We'll be watching those Q2 numbers closely. Until next time, keep digging deep.
Stay curious.